Hey, if you watched my last video on buying deep in the money call options, which is a very bullish strategy, we got great response to that video and got a lot of people asking me if we could do the same thing with put options as a bullish trade. So yes, in this video, if you are bullish, we're going to be talking about selling deep in the money put options with large deltas, 90 delta. We're going to talk about the same type of trades, but in this case, instead of paying out a debit to buy call options or even to buy shares of stock, by selling in the money put options, you're going to get a huge, large cash of money deposited right into your account. So you're not even going to pay anything to potentially get long shares. You're actually going to have a huge cash infusion. Okay, and you still have that 90 delta. Options going to move really big. So we're going to talk about it today. Talk about bullish strategy, selling deep in the money put options. It's a great strategy. Okay, so let's just jump right in. All right, everyone, Lee Lowell here from smartoptionseller.com. All right, so what we're going to talk about today is the Smart Option Seller Guide to selling deep in the money put options. If you watched the last video, and I'm going to put a link for it down below, and I'm also going to put it on the screen at the end of this video so you can see that one if you didn't catch it last time. But what is a deep in the money put option in this case? Well, a deep in the money put option is an option, a put option that has a very large delta that moves almost in lockstep with the stock. But in this case, a deep in the money strike is listed well above the current price of the stock. So what we're going to do is I'm going to show you another example like I did in last time. We're going to use Tesla in this case because a lot of people love Tesla. A lot of people are bullish on Tesla. And Tesla has great option premiums. I mean, these things are so juicy. So you're going to sell these put options. You're going to get a lot of money in your pocket. All right, so let's just go over the list here and talk about what we're going to do when you sell a deep in the money put option. Number one, super important, is that you have to be extremely bullish on the stock. You do not want to sell deep in the money put options unless you're bullish on the stock. So pick a stock that you like, pick a stock that you think's going up. In this case, we're going to use Tesla as the example. It's not a real recommendation here, but since there's so much bullishness out there about Tesla, we're going to focus on that. I'm going to show you a real example here. All right. So also, you want to focus on choosing a strike price that has a 90% delta. If you don't know what deltas are, deltas tell you each strike has its own delta, and deltas tell you how much that specific option price or the option value will move in conjunction with the stock. So deltas range from 0 to 100. The higher the delta, the more responsive the option price is to the movement in the stock. So if you choose a 90 delta or 90% delta, that means the option price is going to track the stock movement by 90%. That's getting good movement, okay? So number one, you got to be extremely bullish. Number two, you want to pick a high delta, okay, 90% delta. And if you're going to take on this type of trade, you're going to want to use a longer expiration, typically about a year out in time. I mean, it's completely up to you, but you have to give the stock time to move the way that you want it to move. I mean, anything could happen in the short term. We're seeing what's happening in the stock market. You know, all the news out there, you know, President Trump's talking about his tariffs and all that. The market's going haywire. So you want to give yourself time to be correct in your bullish assessment. So give yourself time. Okay, in this case, 1 year, but it's completely up to you. All right. Now, also know, as I said, with that high delta, the option price is going to move very quickly, higher or lower. You know, this is a bullish strategy. So if the stock goes down, you're going to start losing money. If the stock goes up, you're going to start making money, right? Just know that when you sell put options, what you want to happen is you want the option value to go down. That's how it works from the short side. Whenever you sell an option contract, your goal is to have that option value go down. So sometime in the future, you can buy it back at a cheaper price. So when you're selling options, you're doing the mechanics are reverse to what most people are used to. Most people think you want to buy low and sell high. But in the case of selling options, you're selling high, then buying low. Okay, so when you're going to sell a put option, you want the stock to go up, which makes that put option value go down. All right, along with the large and cash infusion that you're going to get, I'm going to show you how this works. You can actually earn interest on that money as well. So if your broker pays interest on your cash reserves, you can make some good interest payments. I'll show you how to figure that out. Now, people always ask me, if my option goes in the money, if I sell an option and it goes in the money, won't I be assigned on that option right away? And the answer is no, especially on longer term options. It really doesn't make sense for the option buyer to exercise it into shares of stock. It doesn't make sense to do that. As long as they're holding the option and the option is still making money, what is the point for them to exercise it early? And I'm going to show you the option chain. I'm going to show you why that is. And also, if whenever you sell an option, specifically a put option, you have to keep some collateral, some cash aside. It's called a margin requirement. So if you have a margin account, you're typically going to have to hold aside around 20% of what it would cost to buy 100 shares of stock. If you use a cash secured account, you're going to have to keep that 100% cost of buying the shares aside on hold. Okay, we use margin account because it uses our cash more efficiently, and I'll show you how that works as well. And lastly, when you're talking about any trade you make, you want to have some kind of risk management plan. You want to have stop loss points. So when you're selling put options, especially deep in the money put options, treat it as you would as if you bought shares of stock. When you buy shares of stock, what's your risk management plan? What's your stop loss point? Do you base it on, a technical level on the stock charts? If the stock breaches a certain level, do you get out? Do you give yourself the stock, a 20% cushion? If the stock drops 20%, then you're out. Or do you use a dollar basis? So, you can give yourself, if I lose $500 on this trade, then I'm out. So make sure you have a stop loss plan in every trade that you take. And lastly here, you can sell a put option and you can also buy a lower strike put option as protection. So that's something that you can do as well. When you sell a put option, your risk is unlimited to the stock falling to zero. Okay, so if you don't want to risk all of that, you can buy yourself another cheaper put option to protect yourself from a catastrophic event. All right, so let's go ahead and look at the option chain. Look at an example of a trade here of selling a deep in the money put option. And like I said, we're gonna look at Tesla. All right, so here's the chart of Tesla, and it closed right just under $285 a share. If you can see my mouse here, this is a daily bar chart of Tesla. And, people love to be bullish. So let's just assume that you're really bullish on Tesla and you want to get long Tesla. What can you do? Number one, you can always buy shares of Tesla. Always buy, 1 share, 5 shares, 10 shares, however much you want to buy. But in the case of we're talking options, every option contract consists of 100 shares of stock. So we have to compare 100 shares of stock to one single option contract. Now, in this case, if you were to buy 100 shares of Tesla, it would cost you about $28,500. Okay, but we're not talking about that. We're talking about selling deep in the money put options. So we know that Tesla's around $285. Let's pull up the option chain here and see what we can do by selling a deep in the money put option. Okay, so Tesla last price right around $285. This was trading in the aftermarket. So the one on the chart that I showed you here, this was the 4 p.m. Eastern time close, just under $285. And the option prices, which you see here in front of you, this is an option chain, are also based on that 4 p.m. closing price. The stocks trade until 8 p.m. Eastern time in the aftermarket. So we're going to concentrate, we're going to just assume Tesla's at $285, and that's where all these option prices are based on. So we have the calls on the left, puts on the right. And the only thing that we want to concentrate on here is the bid-ask numbers, the strike price, and the delta. As I mentioned in the last video, if you have a broker and you use their option chains, make sure you have the delta column in there so you can see how to choose a 90% delta. You can see here the lower strikes have lower deltas. As you move higher in the strikes, the deltas go up. So we're talking about wanting to choose a longer term option expiration. So this is in this option chain, here's all the expiration dates. So if we want to go, a year out in time or more, we're going to look at the June 18th, 2026 expiration. Expires in 418 days from now. So it's a little over a year. All right. Now, what you do is when you're searching for these high delta put options in this, here's the strike price. So you have the delta here. So you want to scroll up in strikes until you get to the closest 90% delta, which is this one right here. Wait for the numbers to populate. Okay, so the closest 90 delta is right here. So we're looking at the 660 strike puts. that went out on Friday, 374 bid at 380. So we always want to do something in the middle. If you were to try to sell this thing, you would try to sell it for $377 per contract. Now, each contract has 100 shares of stock. So if you were to sell this thing for $377 per contract, you would receive upfront in cash in your account $37,700 in your pocket. $37,700 in cash that would be deposited right into your account for selling that put option. You're selling the 660 strike. So the first thing that you have to do is you have to understand what would be your cost basis. Okay, when you're selling put options, the end game could be is that you're going to have to buy shares of the stock. If you get assigned, if your option strike is in the money at expiration, you will get assigned the shares. What does that mean? That means you will have to buy 100 shares for every contract that you sell. So if you sell one put option contract, you're on the hook to buy 100 shares of stock at the strike price. That means you'll have to buy 100 shares at $660, which would cost you $66,000 at expiration. But you're going to get $37,700 in cash up front. So to figure out what your cost basis would be, you'd have to subtract the option value, the money that you got from the strike price, okay? All right, so I got my calculator here. So what we're going to do is we're going to take the strike 660 and we're going to minus out the 377, minus 377. So that comes out to a cost of $283, right? Strike price 660, subtract 377 from it because that's the actual value, and it comes to a cost basis of $283. So at expiration, you would have a cost basis of $283. That's where you would have to buy your 100 shares of Tesla. Now with Tesla at $285, you're actually going to be buying it $2 below where it is right now. We don't know where Tesla's going to be in the future, but we hope Tesla's going to be higher than that. So at a minimum, you know that your cost basis is going to be $283. If Tesla is below that at expiration, you're losing money. If Tesla is above that at expiration, you're making money. So even though at expiration, you're going to have to pay $66,000 to buy the 100 shares, you know up front, you got $37,700 in your pocket. So that's the difference. Okay, that's where your $283 cost basis is going to come from. So there you go. That's how you figure out what your cost basis would be. Now, as I said, when you get the money up front, the $37,700, that gets deposited right into your account. So if you have a broker that pays you interest on that, or you can put that money into a money market fund that's paying, 4% these days. Let me show you how much money you can get on that. So 37,700, times your 4%, you're getting $1,500 over the course of the year, over the course of the expiration date. So this is a little bit longer. This is almost 14 months. So if we divide that by 12 and then we times it by 14 months, or almost 14 months, you're looking at almost $1,700 that you're going to get over the course of the trade. If it's held all the way to expiration, that $37,700 that you got sitting in a money market fund is going to give you an extra $1,700 on top of the $37,000 that you're getting up front. So it's actually a pretty good deal. Selling these in the money put options, you're going to take in that cash, put it in the money market fund, get the extra $1,700, and then you wait to see what Tesla does over time. I want to show you how you can understand how now people will ask, well, how do I make money on this trade? Well, if Tesla stock goes up, that means the option value starts to go down. All right. So if you sold the option for $377 per contract and it starts to tick lower, that's how you make money. As long as Tesla goes up in price, the option value will go down. So let's look at a option calculator here, and we're going to show you, or I'm going to show you how that works. So I've loaded up the option calculator here that you can get at the optionseducation.org website if you don't have an option calculator already. Now what we did is typed in Tesla. Let's put it at $285, and we're looking at the 660 strike for the June 2026 expiration. And we can see that the delta, so we're looking at the puts here. Here's the inputs on this side. The outputs are over here. So we're only looking at the puts. And we're looking at the strike price of $660, while Tesla's at $285. Here's the expiration date, and all these other numbers default in. And you can see right here, the option value is roughly $377 per contract. That's exactly what we figured out. You can see the delta is right around 90%. So what will happen is that if Tesla stock goes up by $1, this option value should go down by about 90 cents per contract. So that's 90%. So let's take Tesla up by $10 per share, and this option price should go down about $9 per contract, taking it to about $368 per contract. So let's change the input to $295, and we'll see what happens. So there, the option price went down to roughly $368 and change. So it moved down about $9 per contract. That's how you make money. If Tesla goes up another $10 to $305, this should go down to about $359 per contract. So let's raise this up by another $10, $305. And now we'll see what the option value is. So you see right there, $359. So that's how you're making money. As long as Tesla goes up in price, that put option value goes down. So if you originally sold this for $377 and now it's $359, you can buy it back for $359 and lock in an $18 per contract gain, which is $1,800 actual dollars. If you're like, I'm out, I made my money, I made $1,800, I'm fine with it, because you think Tesla's not going to go up any higher. So that's how you make money. The one thing that you need to know, though, about when you sell an option, what you sell it for is the maximum amount of money that you can make. So $377 per contract, which is actually $37,700, that's the maximum that you can make ever on the trade. If Tesla goes up to $1,000 a share, you're not going to participate in that full move. You're only going to make whatever you sold the option for. So the last video I made, which is buying deep in the money call options, that has an unlimited gain potential. When you sell options, it has a limited gain potential. That's why you want to sell put options with a very high delta. And let's go back to the option chain here. So really, you've sold a 660 strike. Tesla's at 285. So in a year, the most you can make, I said, is the $377. But Tesla has to get above 660 in order for you to start missing out on more profits. So Tesla has to go up another $375 a share in the next year before you start losing out on, unlimited income. Let's look at the chart here for a second. So here's the chart of Tesla. Tesla has to go up to right up here somewhere in the next year, all the way up here, before you start missing out on extra profits. Okay, that's a long way. $275, it has to go in 1 year's time. I think you'd be pretty safe knowing that you're not going to miss out on more profits. So let's go back to the option chain right here. So does everyone understand that? Once Tesla goes above $660, you're not going to make any more money on top of the $37,700 that you've already captured. Okay, so that's how you make money, by selling a deep in the money put option. Now, on the other hand, if Tesla starts going down, that option value is going to go up. Let's look at the option calculator one more time. So we started at $285 and the price is $377. So what if Tesla dropped to $250? Okay, Tesla went down. Now that option's worth $410 a contract. You just lost, you're $3,300 in the hole. You sold it at $377. Now it's worth $410. So you're actually losing money. So it's going to make money and it's going to lose money very quickly. It's tracking the stock movement by 90%. You just have to understand that. All right, so let's go back to our cheat sheet here. Make sure we understand what we're doing. If you're extremely bullish, you can either buy shares of stock, you can buy deep in the money call options, or you can sell deep in the money put options. By selling the deep in the money puts, you're going to get that huge cash infusion, and you're also going to be able to put that in your account, hopefully earning interest, so you're going to get even more money on top of that. Now, as far as the potential for getting assigned early, being assigned early means, what if the option buyer, the put option buyer, decides to exercise the options and turn those into shares of stock? That means you're going to have to buy your 100 shares well before the expiration date runs around. Now, I'd say 99% of options do not get exercised early. There really is no reason for the option holder to exercise it. It doesn't make sense for them. As long as the stock is moving in the right direction for them, their option is going to make money too. You don't have to turn the option into shares of stock to capture profits. It doesn't make sense. Now, if the option buyer did decide to exercise early, they're going to miss out on a lot of profits, okay? They're going to miss out on extrinsic value. I know most people don't understand what that means, but it doesn't make sense for them to exercise. So if they made you buy your shares of Tesla at $660 per share, you could turn around and start selling covered calls for the 660 strike and get about $1,540 for each call option that you sold. Okay, if you understand how covered calls work, you have 100 shares of stock, you sell a call option at a higher strike, and you get the money. So in this case, let's just say the option buyer assigned you the shares, and now you're long 100 shares of Tesla at your cost basis of $283. You can turn around and sell the 660 call for $1,545 or $1,550, $1,550 per contract. To understand how that works, let's go to the current May 16th, 2025 expiration, which is 20 days from now, and look at that same 660 strike. And you'll understand why it doesn't make sense for the option buyer to exercise the options early. So the 660 strike here has a value of a penny, $1. So you can see if they assigned you the shares 20 days out, you wouldn't be able to collect any money by selling these call options. But for the June 2026 expiration date, let's go back to that. For those 660 calls, you're going to get, like I said, the $1,550. So it wouldn't make sense for the option buyer to exercise early. It just doesn't make sense for them. So you could hold on to this trade knowing that you have many, many months where that cash infusion is going to start earning that interest if you put it in the money market fund. Just know that if you hold this thing all the way to expiration, you will have to pay, and you get assigned, you will have to pay the $66,000 in cash to pay for the 100 shares. But remember, you got that $37,700 up front, making your cost basis $283. All right. So that's it. That's how you do it. That's how you make a bullish trade and get paid to do it. It's pretty cool idea. All right. So let me show you quickly what we do here. Go to our website, smartoptionseller.com. If you know nothing about selling put options, you want to learn a little bit more, here's our free ebook. Go to the More tab here. Click on the free ebook, free guide, Put Selling Basics. You can learn about it, why we love it so much. Put in your name and email address here. We'll send you an email back with a copy of the free ebook. If you want to go a little bit deeper, we have our video series here that it's a 5-part video series, 5 hours long, deep dive into put selling. But we also have this coming Wednesday on April 30th, our put selling webinar. Click on the link here if you want to join us live, read through this, see what it's all about. Our services that we offer, we have 2 newsletters. We have our one-on-one coaching and our probability calculator. Take a look at it. We also have our Warren Buffett ebook. Talk about the deep in the money strategy. Call options, take a look. I tracked this over a couple years. You want to follow Buffett. I mean, you can't go wrong riding his coattails. All right, that's it for me today. Let's bring up the cheat sheet one more time. Take a look at this. I hope this has been helpful. Give me a thumbs up, give me a like, leave me a comment. Make these free videos for the trading community. We're all trying to help each other out. Send me an email. Always answer emails. Lean on me. I'm here to help. All right. Coming up on the screen here is the video, the last one, the Buying Deep in Money Call Options. Have a look at it. And down in the description below, I've got links, books, websites for things that may help you as an option trader. All right. That's all for me today. I'll see everyone in the next one. This is Lee Lowell signing off.